trader. All right, let's jump into this one. So we're looking at this day, Friday, as we get into the AM model creation. So daily chart, we're looking at the week just really rolling over, going down bearish into these levels. Marked out these two fair value gaps. I had this old high as a reference point, and I wanted to watch how price responded specifically on Thursday. So here's that hourly chart. Thursday low profile was what I was expecting. So as price made this wick on Wednesday, I was waiting to see if we would make a further dip on Thursday, which we did, and then we started to see price shifting out. But the challenge here is going to be when and how to enter, and I'm using the AM model, which takes the intraday profiles from month 8 and merges it with the profiles from month 10 in ICT's core content. And I'm also using the information on Asian range and concepts on inversion, which ICT talked about on March 31st. And I'm blending a piece of time distortion, which came from St. Kish, or the currency merchant on Twitter and YouTube. And I'll put a link to his channel as well in the description. So this is the AM model, which takes the profile using the Asian range as a measure and looks at the price action on the model from 2 a.m. Then after the London kill zone, which is 5 on UTC5 time zone, all the way up until 9 on UTC5 on the time zone. Ignoring that price action, or referencing it loosely, and using the reference points from before the time distortion, so levels that were relevant in London kill zone, and depending on how price shapes out, use that as my entry. So here we have the Asian consolidation. We had a run up just before or around 2 a.m. After 2 a.m., price dips down into the Asian range, and we're looking to see some sort of expansive move. And right in between this little gap of time is the AM model for me. So what I'm using is the reference points between this price action, which happened in the London Open, and this dip right here. So that small price action is where the AM model comes in, and so that's what we have here. So price consolidates in Asia, makes a run up, retests the midpoint of Asia, and drops into this small fair value gap balance price range here, chops around, creates a volume imbalance. Then we freeze time, or consider that movement as price distortion. Price clears above the buy side, returns into an area of interest from London, and then kicks off. So here is the chart with the time distortion removed, and price moves up, clears the buy side, comes back down, tests the volume imbalance, which is the relevance of that red rectangle. And as price is kicking out, I'm looking for areas where price will allow an entry for a long. So this tiny fair value gap in here, which is really my markout from the balanced price range. But because of the relevance of time, even though that entry was nice, even though this entry was nice, even though this entry was nice, I really am waiting for 9 o'clock. So allowing the time distortion to do its thing, and following the rules of the model, I would be looking for an entry on either this old order block bearish inverted to now become a bullish array, or this balanced price range, which on this leg down could have been considered bearish, but I'm using it bullish because of where price opened after the distortion. So price runs up, and we're looking for down here in the bottom left corner this leg up to kick off in New York. So we have the AM model complete, and it runs to that daily fair value gap and the 50% mark. So that's going back to the daily chart. That's this daily fair value gap here where price ran into, and the 50% mark. So that kicks off, and we're anticipating that we'll see, after a push up, some sort of dip down, and we'll switch gears into a different profile from month 10 on the PM session. So the PM session for the past few days has been kind of trash. I mean, price makes these massive runs up, and it is really framed around the economic calendar. So here's a PM session in a nutshell. Price runs up. We had a news event from at 10. So looking at this price action from 11, we'll see that price ran down, tagged into a 15-minute array. The lunch macro sought liquidity in this imbalance, pushed down, broke below the AM imbalance. So this fair value gap becomes relevant again. Price retests the fair value gap, dips down below the lunch low. Now, if this were considered to be an AM rally, PM decline, or PM reversal model, we'd be looking for price to be kicking up into a 50-minute array. There was an SMT, but there's something that I've been using, which is the lunchtime low, as a warning sign as to whether or not a profile will play out or not. So 15 and 60-minute arrays above and below the AM low is always going to be relevant. So if there's any 15-minute array above this AM high, or if there's a 50-minute array somewhere below an AM low. Now the relevance of news and 11 o'clock gives this swing low more importance than a previous swing low. So this swing low dips into a fair value gap. Even though there is a lunch macro suggesting lower prices, the first warning sign or signal of concern is that we did not cleanly clear below the lunch low between 1 o'clock and 1:30. So that's the first warning sign. Price kicks up, going into the halfway point of an order block. Again, the lunch low doesn't have consecutive candles, so these candle patterns are more reversal than continuation. So made a move down, dipped into the 50-minute order block, immediately rejected and closed above the lunch low. That's the first warning sign. The next warning sign is when price in the PM session, so now we're in the PM session, which is 1:30 to 4, we get back into this order block, mean threshold of the order block, because there are no fair value gaps preceding it, and we do not clear the lunch low. So again, we make a dip below and then a rejection immediately after. So that gives that's enough. That's plenty of warning signs to say, even if an entry was taken on the lunch macro, or if something was seen here in the PM session on this order block, not clearing the lunch low is a warning sign. Rejections of the lunch low are warning signs. So whether the 50-minute array was seen or not, confirmation or knowing when a trade is less likely to pan out. The next warning sign, if any, 3 consecutive candles closing back into the order block. That should not happen on a PM decline, and so that invalidates it 100%. So if this was not the first warning sign, stayed in. If that was not the second warning sign, stayed in. If that was the test of the order block one more time, just running short of the fair value gap, stayed in, then this for sure should have been it, and this for damn sure should have been it. So price then runs all the way back up, and on this model, especially a day going into a holiday, would not expect a lot of activity after 3. First target would be the lunchtime high, so this is the high created inside of lunch. 15-minute array runs all the way up, tags the lunchtime high for good measure, tags a high right at 11, and then evaporates for the rest of the day. So this is the AM model getting refined and really narrowing down on time, and still keeping the PM model, which, like I said, for the past few days just kind of seems to be a bit of a fizzle. So it seems like this AM model creation came in just in the nick of time. Alright man, we'll do it again.